Welcome to the Daily Update Podcast, where I'll go over the action in the market for Tuesday, September 16th, and we'll see how things look for Wednesday, September 17th. The S&P 500 started with a strong day, hitting an all-time intraday high at the open, but it closed slightly lower, down 0.13%. This pullback reflects a cautious market stance as investors await the FOMC announcement on Wednesday at 2 p.m. Eastern Time. The NASDAQ and NASDAQ 100 also touched intraday highs but ended the day lower, underscoring the market's fixation on the 25 basis point rate cut and their accompanying statement. Notably, trading volume was below average, signaling apprehension among traders as they position for potential volatility. Going over technical analysis, from a technical perspective, the S&P 500 opened above the R1 pivot point at 66.23, but declined below the daily pivot at 66.12 and down below S1 at 66.05, ultimately finding support at 6600. Despite this dip, the index remains above its 20, 50, and 200-day moving averages, indicating positive trends across the short, intermediate, and long-term timeframes. Short-term indicators including the Stochk RSI, Williams Percent R, CCI charts show strong positive conviction, though some are starting to decline. Intermediate-term indicators are mixed, with some showing strength while others show weakness. The S&P 500 continues to sit 10% above its 200-day simple moving average, which could signal a potential pullback if it continues to climb. This overextension warrants close attention. Looking at the economic indicators, the economic data provided a mixed but generally positive picture. Retail sales rose 0.6%, double expectations, with core retail sales, excluding autos, up a robust 0.7%. This is signaling continued consumer strength. Industrial production edged up 0.1%, slightly below expectations, while capacity utilization held steady at 77.4. Elsewhere, import and export prices each increased by 0.3%, and business inventories rose 0.2%, aligning with forecasts. The NAHB Housing Market Index came in at 32, just shy of the expected 33. These numbers paint a picture of a resilient economy, though not without challenges. Looking at market sentiment and trends, market sentiment remains positive but not euphoric, suggesting there's still room for upside before the market risks overheating. The U.S. dollar index continues to weaken and is in a downtrend, while the 10-year Treasury yield held steady at 4.03%. Gold prices, however, hit a record high in real terms, hinting at some underlying market fear. In sector performance, growth stocks lagged value stocks on Tuesday, with discretionary sectors showing strength compared to staples. Energy and healthcare posted gains, while utilities, communication, and tech saw declines. This divergence highlights a market navigating mixed signals as it braces for policy updates. Moving over to the Fed and policy focus, all eyes are on the FOMC. The markets are pricing in a 25 basis point rate cut, but the real focus will be on the Fed's summary of economic projections and their commentary. With additional meetings in October and December on the horizon, investors are looking for clues about the pace of future rate adjustments. Moving over to internal market dynamics, despite the S&P's upward trend, there are signs of internal weakness. Advanced decline ratios and smart money indicators are declining, as well as the McClellan oscillator. Fewer stocks are trading above their 20-period moving averages, and new highs are starting to taper off. These cracks in market breadth could signal challenges ahead if not addressed by positive catalysts. Looking ahead to Wednesday, September 17th, the FOMC announcement at 2 p.m. Eastern will be the day's defining event. All of the markets will be laser-focused on the Fed's language and projections for clues about future policy. In addition, there'll be key economic reports, including the weekly MBA Mortgage Applications Index, housing starts, and building permits. It's worth noting that mid-September historically marks a weak period for the markets, with the second half of the month being the worst performing period going back to 1950. It is important to stay vigilant in case this starts to develop. In conclusion, the S&P 500 remains positive across all time frames, and in some areas is showing overextension, and in other areas is showing weakness. Short-term conviction remains strong, but is weakening slightly, and the mixed intermediate term indicators and emerging internal weakness suggest caution. Wednesday's Fed announcement will likely dictate the market's near-term direction, with potential support at the 20-period moving averages if a decline occurs. Thank you very much, and I will talk to you in the next podcast.